in the Zipcar model, it assumes that, in the mind of the customer anyway, that they value access over ownership, right? That they're willing to trade ownership for a fractional access to a product owned by someone else. And in our model, which is not peer-to-peer, which is where Zipcar owns and maintains the vehicle, it delivers a little bit more certainty to the member experience, right? So I would define that, again, probably more in the minds of our customers, our members, which is that typically they value access to a product over owning that product themselves.
You're speaking to kind of changing consumption patterns and different valuations as a growth engine for this. Are there any other types of things that you think are spurring growth? Because people estimate that the sharing economy is now north of $30 billion, dollars. So what do you think is the main drivers behind growth right now?
I do think there is a certain extent to which the sharing economy in particular, we learn from one another, right? Zipcar was, in a position 15 years ago where we really invented the car sharing category in North America. It hadn't existed before, and really enabled a world of Zipcar ofs, right? So now you have Rent the Runway, which is, a similar service as anyone's ever used it. If you want access to a designer dress, don't want to own it, you can access it and they'll ship it right to you. And so I think, there's a certain extent to which, we didn't invent, to your point earlier, we didn't invent the vehicle technology, certainly cars that existed before, but we operated in an era 15 years ago where sharing was more commonly associated with socialism than capitalism. And so I think we have really, over the course of these years, really built on lessons learned by other operators in this space to try to make the service work even better for our customers. And I think, we'll eventually reach a time and a day where, sharing an asset can be as convenient and as easy as owning an asset. And that's a day that I think we're getting closer and closer to.
Maybe to add to that too, there's, probably complacency of incumbents in many industries. I think if there were great hotels everywhere. If New York wasn't, average hotel room $350 a night, those types of things can drive people to look for alternatives. Taxi industries, so that's probably another factor that has driven not only the need for these companies, but the consumer adoption is, wow. In San Francisco, you guys are way better than the alternative or the former alternative, which was a taxi. Now I don't know anyone there that takes taxis unless they're just really in a bad spot.
Spencer, I think it was you who defined this sharing economy as decentralized ownership. But to some extent, both your business models rely on some centralization, whether that's the centralization of the underwriting process or of the ownership of the car that other people are using. But there's another model which relies on more decentralization, where the company acts as more of a platform to bring someone who doesn't need the asset with someone who wants the asset together. So, for example, I'm thinking of relay rides in the market of cars. To what extent do you see those the pros and cons of those models, and do you think they're appealing to different customer bases, or how do you see those sort of companies?
Yeah, I think we are different in that sense. So, Lending Club is more the relay rides model. We the supply side, the investor side, is made up of diverse set of investors. So we don't actually lend out our own capital to borrowers. Of course, Zipcar owns the fleet for the most part, I assume.
Yes.
So I think when I said that it was decentralized, I think that's probably more indicative of the new sharing economy. Laundromats were not decentralized. They were owned by the laundromat owner, but they were a sharing economy. You could think of 1,000 examples back to Roman baths and whatever else, but it's a good question about the benefits of the model, of the two models. From probably our model is more capital light. They have to buy cars or lease cars. So maybe getting started day one, if you don't have a lot of capital in the bank, it makes more sense. But as a lender, it's important to us to not have that credit risk on our balance sheet. So that's what a lot of investors like about us. If we, I think On Zipcar's side, I mean, we've seen it with some of their competitors, and I'll speak on your behalf, and you don't have to say it, but it's a difficult experience to get a car. With Get Around Relay Rides, there's a lot more friction in the handoff process, where theirs is more seamless. So that could make more sense for them long term, but good question.
Yeah, no, and certainly our approach, as you point out, is more capital intensive, right? But for us, it's about delivering an exceptional member experience so that you can live without your personally owned car, right? And so I think that particularly for a vehicle that can depreciate quickly, the standards of cleanliness can be somewhat off-putting. I think in order to deliver on that exceptional experience that also comes with a certainty and reliability that you might have been accustomed to if you owned your own car, I think that drives part of the way we orient our business. And that may not necessarily be the case in some of the peer-to-peer model, at least in our context.
Interesting now, though, I mean, Airbnb, once again, sorry, but they're taking, I mean, there are owners that own 12 units and rent them out as a business in San Francisco. Yeah. So they're kind of convoluted in that sense that it's not always maybe as it seems. But yeah, I mean, I think either approach can work. I think for a lender, it makes sense for us. For what they're doing, it makes sense for them. But I think it really depends on the industry.
I think another challenge that, and I'll speak outside of our industry, but that you have in the peer-to-peer model, or again, there's no maybe central control over the asset, is how do you, if you assume that the organization's brand is valuable, how do you prevent against brand delusion when you're not necessarily as engaged in delivering the service, right? And I think, that can be a challenge in some companies. How do you protect that? It's a function, I think, or customer experience is one facet of the overall brand experience, but I do think it's a challenge when you don't have as great of control that you may lose a little value there.
On the flip side, the amount to which the company itself puts themselves in the middle of that transaction, the work required to make the transaction happen, I think that should directly correlate with the amount of value that company extracts from the transaction. So I worked at TaskRabbit. That was a challenge for them because every task that was posted required some manual work. It wasn't fully automated. Someone had to review the task, make sure it was in line with their standards. End of the day, if the average, I have no idea, average task is $50, so their revenue is $8, $10, $12, and someone has to do some work to make that happen, that's challenging. So, I mean, same thing for you guys. As owners of the automobiles, you guys should take a larger cut. You have that capital expense on your balance sheet. We do a good bit of work to underwrite a loan, so we take our cut. But sometimes it just makes a business difficult to scale if you don't have that proportion in line.
TaskRabbit, interestingly enough, was incubated at Zipcar.
That's right. Yeah, Boston.
You guys are linked.
Exactly.
Just you bring up an interesting point, because I think a lot of the focus on the more peer-to-peer, what you're talking about, is on the positive side, when things are going well and you can see these great effects. But the downside risk of when things don't go so well, right? And the lack of control that you give, that increases the opportunity for that to happen. So things like managing risk, something I'm sure you guys think a lot about, right? Insurance, something I think you think a lot about, but you're able to control that because they have control of the asset. But if you have that distributed, insurance becomes a different type of issue. So the things that kind of manage and mitigate the downside risk become much more significant in the peer-to-peer model. And I don't think a lot of that has been realized yet. We haven't had a lot of bad experiences.